Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically in the financial system, what we are covering, that we are covering the foreign investments. All right. And basically in foreign investment, these are the topics we are supposed to discuss, like the foreign direct investments. Okay. Foreign institutional investments. All right. And foreign portfolio investments. Okay. So these are the topics we have scheduled for the discussion. Out of these, basically, we have covered the FDI in the previous lecture, and now we are left with the foreign institutional investments and the foreign portfolio investments. Okay, so basically, what we will do that we will discuss about the foreign institutional investments in this lecture. Okay, so let's start. So we are going to start with the introduction first. So the foreign institutional investor is an entity or the organization that invests money in financial markets of a country other than whether it is based or registered. So here is one thing that we could conclude here is that the institutional. Okay. So what is institution signifies here? Institution basically signifies the group of individuals rather than a single individual. All right. So you could say, like in the FDI, foreign direct investments, there are the chances that the single or multi entities will make the investments. All right. But in the foreign institutional investments, basically this is the group of individuals, not a single individual. All right. It means that the group of individuals come together and form the institution. All right. So remember this thing. Okay. And second thing which we could see here is that in financial markets of a country other than whether it is based or registered. What does it signify? So basically it signifies that the entity or the company is from outside India, right? This one. Okay. That is what we had already, you can say C. All right. In India, the term FII is widely used for describe foreign entities that invest in Indian financial markets, such as stocks, bonds, and other securities. These investors can include hedge funds, mutual funds, pension funds, insurance companies, and other large institutional investors from outside India. Okay, so basically, what you can say we could conclude here is like, suppose there are 8 people. 1, 2, 3, 4, 5, 6, 7, 8. There are total 8 people, and they all, you can say, pooled their money. All right, pooled their money, and you can say that this has become the group or the institution. So we could conclude that the contributed money is totally about rupees, or you can say dollars. Basically, we are talking about the foreigns, then we will talk about the international currency. So you can say that suppose the pooled money is nearly about USD 40,000. All right. So what will they do? That they will spend this 40,000 into financial markets. And basically we are talking about Indian context, then this will be a Indian financial markets. Okay. So we could say that some foreign individuals made their group, pooled their money, formed an institution, and then invested the pooled money into the Indian financial markets, into the various, you can say, the products which we offer, like the stocks, like the bonds, and other securities. All right. And which type of investors they could be? They could be the hedge fund investors, the mutual fund investors, all right, and the pension fund investors, even the insurance companies. Okay. So about, you can say, the hedge funds and the mutual funds we had discussed. Okay. In pension funds, we had also discussed in that, you can say, the lecture of PFRDA and insurance company. Okay. About this also we had discussed. Okay. So this could be the potential type of investors who invested their money through FII. Okay. FIIs plays a significant role in Indian financial markets by providing liquidity, diversifying investment options, and bringing in foreign capital. They are regulated by the SEBI, Securities and Exchange Board of India. Why? Because they are investing into the financial market of our country. And as we know that our country financial market is basically regulated and controlled by the SEBI. Alright. So ultimately they have to pass through a SEBI and are required to follow the certain rules and regulations regarding their investments in India. All right. So keep this thing in your mind. And here is one thing also, like diversifying investment options and all. So what is the meaning of this? All right. So we could say, suppose Indian financial market requires a foreign investments. Okay. In a huge quantity. Or you could say, for example, that we required at least US dollars 15,000. Okay, in the stock market, just for example. All right. So basically, if we look at here, then it is a huge amount. It means that it is a large chunk. Okay. No single individual is able to invest this much of amount. So basically, our first approach will be foreign, what? Foreign direct investment. Also, we could call it as a FDI. All right. It is our first preference. But what if no one, or you can say no foreign entity, is looking forward to invest in India? All right. So we could say that our option or our chances to get the FDI is bare minimum. All right. So what will happen? That in such a case, if we require this large chunk, then the FII are the options. Why? Because this is somewhat like a money pooling, right? So what will happen? That the money pooling is easily meet up the criteria we are required. It means that it could easily meet the required amount or requirements. All right. So that's why it is a best option for diversify the investments and bringing the foreign capital. All right. Thereafter, China. The term FII is also officially used to refer to the foreign entities investing in country's financial market. Okay, it means that China also use the same term as we use in India, which is FII. Similar to India, these investors play a crucial role in the Chinese financial markets and are subject to the regulations set by the Chinese government. Okay. Overall, FIIs are important players in the global financial markets. They contribute to cross-border investment flows and influencing the performance of the financial markets in different countries. All right. So now we are going to check out their composition. Foreign institutional investors are institutional investors from outside the country who invest in the financial markets of the another country. By reading the name itself, by by reading the name itself, you could conclude that these are the outsider countries, right? They can include a variety of entities such as hedge funds, insurance companies, pension funds, investment banks, and the mutual funds. Like here, we have got two things like the hedge funds. Second is our mutual funds. Okay, so what is the similarity and what is the difference between them? Let's revise it. Okay, so basically, whenever we talk about the hedge funds, it is a money pooling scheme. And whenever we talk about the mutual funds, it is also the money pooling scheme. Okay, both the same things. But now here is a difference. First is huge amount, less amount. Okay, second is high risk and high fees. Low risk and low fees. Third is that no withdrawal within specific periods. Withdrawals allowed without any period. That is a difference. Alright, like hedge funds are the money pooling, mutual funds are also the money pooling. That is the similarity. Difference is that hedge funds requires a huge amount to contribute into the fund, whereas mutual fund is all about the less amount which could conclude. Okay, so you can say only the large investors could participate into the hedge funds and the common people could participate in the mutual funds because the joining amount is very less. Second, hedge funds are required to obtain a more profit. So what they will do, they will buy a large chunk of securities. So that's why there is a high risk. Okay, and the managers who are managing the hedge funds are, you can say, much more professional in comparison with the mutual fund managers. That's why their fees are also high. Okay, whereas the mutual fund is all about the continue, you can say the continue earning. So that's why it is having the limited number of securities, so that we call it as a low risk. All right, and because the professional managers are, you can say, not so as much capable as the hedge funds are, so that's why they're having the low fees also. Thereafter, in hedge funds, no withdrawal within specific period is allowed. Okay, it means that the money will be locked. Suppose the hedge funds, while you are submitting your money in the hedge funds, they had make you to sign the agreement of joining. In agreement of joining, it was mentioned that if you join in January, then you can say before July, you could not withdraw your amount. So it means that till you reach July, you are not allowed to withdraw your money. But these conditions are not there in the mutual funds. Anytime you want to step out, you could easily. Okay. Thereafter, what about the insurance companies? Okay. Like insurance companies also runs different type of mutual fund schemes. All right. So you could be benefited there. All right. Thereafter, the pension funds. What are the pension funds? So basically, what is happening here? Like, if we talk about the system of pension, all right. So suppose if your monthly income is rupees 40,000, All right. And if you join some pension scheme, so what will happen? That suppose 1200 on monthly basis will be deducted from your account. All right. Till when? Till you get retired. All right. And thereafter, the the accumulated amount will be redeemed back to you in fixed portion, all right, or pension form. All right, this is the thing. Okay, so if you opted for the pension scheme, some contribution will be taken out from your account till you get retired. Okay, and the accumulated amount will be redeemed back to you after retirement in some fixed portion, or you can say in the pension form. It means regularly you will get some portion of your accumulated amount. Okay, that is a scheme of pension. But some pension schemes, apart from just only the redeemment of the accumulated amount, also provide other benefits. Okay, so that's why that suppose if not only you, many people, these are the pension fund members. Okay, many people contributed the fixed percentage into some fund, and suppose US dollars 20,000 is the total accumulated amount counting the contribution made by each and every person of the group. Then what will happen? There's the amount, or you can say this pension fund will be invested into the financial market of India. Okay, and whatsoever the profit will be collected will be sent to the pension fund members. Okay, so that's how the pension funds works. All right, these entities pooled funds from various sources and invest them in the financial instruments like stocks, bonds, and the other securities. Got it? Thereafter, understanding the FII. Okay, role of FIIs in developing economies. FIIs plays a crucial role in developing economies by providing a source of capital that can stimulate economic growth. They bring investment funds that can be used for infrastructure development, job creation, and the overall economic expansion. Like as we had discussed, that whenever we talk about the huge chunk of the foreign capital, our first priority is always the FDI, right? Because FDI will not only invest the liquidity into the market, but also they will create a jobs, right? But if somehow no foreign entity is willingly to invest in India, okay, in such a cases, basically the FIIs are the largest chunk. Why? Because through the FIIs, a huge chunk come to the Indian financial market. Okay, because as we had discussed that this is a collection of funds, so a huge fund could be accumulated there. All right, and this could be crucial for developing economies. Why? Because when we talk about the developing economies, so you can say that there are many fast growing medium and small businesses, right? And these businesses are require the capital inflow so that they could enlarge their business so that they could expand them. All right. So in such a scenario, the FII's investment is become very, very crucial for them because they will get the liquidity. And once they will get the liquidity, what will happen? The job creation will start it. All right. FIIs also contribute to the liquidity and the efficiency of the financial markets, making them more attractive to the other investors. How? So suppose when whenever the FII will make the investments into the market. So what will happen? The liquidity of funding to local or domestic companies will be higher, right? Okay. And what will happen? That they will start growing and prices, or you can say shares and the securities of these companies will also be growing, right? And then what will happen? That ultimately the market will grow. And when the market will grow, what will happen? That bring opportunities. All right. And then what will happen? New investors will be getting attracted. All right. So this is the flow chart. Okay. Whenever the FII will make the investments, liquidity or funding to the local or the domestic companies will become, you can say, higher. All right. And then what will happen? That these companies will start growing. And whenever they will growing, their valuation will grow. And if the valuation will grow, so what will happen? The value of shares and the securities of these companies will also be grow. Okay. And when they will grow, the market will start growing. Okay. And as the market will start growing, so the opportunities will be starting coming. And when the opportunities will come, then the new investors will be attracted. Okay. So you could say that just only through the investments of the FDI, how many things could be possible, right? So that is why it is written down here. Thereafter, limits on FIIs in the developing economies. Despite their importance, many developing nations, including India, have imposed limits on FIIs to prevent excessive influence and the potential risk. These limits include restrictions on the total value of assets an FII can purchase in a country's financial markets. Restrictions help ensure that FIIs do not become overly dominated in market, which could lead to the market manipulation or destabilization. Like there are two major perspectives about the limit on FIIs. First is immediate withdrawal. Okay, that's the first reason. Second is destabilization of the market. All right. So if we try to decode this, first is the immediate withdrawal. What does it mean? It means that the foreign institutions are basically the group of entities. Okay. And the institution is basically serving the needs of those group. Okay. But what happens? Suppose if there are two developing countries like India and Indonesia, for example, and there is a you can say pensioners fund. For example, the Canadian pensioners fund. Okay. So what will happen that after seeing the growth opportunities, the Canadian pension funds or the institutional investments have been made to the India. So what will happen? The Indian market will start growing. But due to some conditions that these Canadians find that Indonesia is become much more attractive in comparison with the Indians. So what will happen? That they will start withdrawing their money. Okay. And when they will start withdrawing their money and invest them into the Indonesia, what will happen? The market valuation of Indonesia will be goes up, but the market valuation of the India will be coming down. Okay, so you can say that will be a threat for Indian. Okay, that is the first reason why we do not want ourselves to be dependent on the foreign institutional investments, because their withdrawal at any time could cause a huge damage to the country. Thereafter, the destabilization of the market. It means that if due to the influx of the huge capital into the market and the inflation was decided to be set at certain percentage, but once the you can say the foreign currency will enter the market, then automatically you could say that the monetary circulation will be goes higher, right? That will happen. And whenever the monetary circulation will goes up, the inflation will automatically goes up. Okay, so what will it leads to? It leads to the destabilization of the market. So these are the two prime reasons why the developing countries, despite the importance of the FIIs, put some restrictions on them. Okay, so that they could not damage the economy's growth just by the immediate withdrawal. And second is excessive inflow of the foreign capital maybe leads to the market manipulation or destabilization. All right. Thereafter, understanding the FII's restrictions on the equity shares. Okay. So we could say that we had discussed about the equity shares in the previous lecture already. Okay. Equity, okay, equity, non-equity, all right, and other kind of things. So basically, so far, students, what we have tried, that we have tried to draw a picture of the FII. Like we had, you can say, seen the institutional meaning. Okay, we have discussed the reasons why the government do not want FIIs to come to India or come to the financial market in more excessive way. Okay, because whenever they do immediate withdrawals, basically it hurts the economic growth of the country. Okay, and whenever they come to the country, you can say at full-fledged, basically the market manipulation could be done. All right, so these are the two prime reasons that we avoid them. So basically in this lecture we have covered till here. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.